Right now, everything looks quiet. The financial markets are closed. Trading screens sit dark. The ticker tape has stopped moving. Silver is frozen at $71.47 per ounce. It feels peaceful, like the world is taking a break for the new year. But that peace is an illusion. Under the surface, pressure is building to levels we've never seen before. We're standing in the eye of a storm that's about to explode. Tonight at 6 p.m. Eastern Time, the electronic futures market reopens. When that switch flips, capital that's been waiting on the sidelines for 2 weeks is going to flood in all at once. We're not just starting a new trading day, we're starting a new trading year. And here's what most people don't understand. In institutional finance, the first week of January is the most violent, explosive, and profitable week on the entire calendar. It's called the January effect. It's a mechanical phenomenon where hundreds of billions of dollars of pension fund money, insurance capital, and hedge fund assets are forced to enter the market to rebalance their portfolios. This year, they have a massive problem. Their computer models are screaming at them to buy the best performing asset of 2025. That asset is silver. But there's no silver for them to buy. The vaults are empty. The dealers are sold out. The miners are hoarding their supply. So when that $50 billion wave hits the market tonight, it's going to slam into a brick wall of scarcity. Think about that for a moment. $50 billion chasing an asset that barely exists in available supply. In this investigation, we're going to prepare you for the opening bell of 2026. We're going to explain the exact mechanics of the pension fund panic. We're going to show you why the same banks that crushed the price on New Year's Eve are about to flip their entire strategy and chase prices higher. And we're going to give you the battle plan for the next 48 hours. The countdown has already started. The money is queued up. The price is about to move. This is the story of the January squeeze, and you need to understand what's coming. To see why tonight matters so much, you have to understand how Wall Street actually works. Retail investors trade on feelings. They buy when they're excited. They sell when they're scared. But institutional investors trade on dates. December 31st is the fiscal year end. Until midnight last night, the entire game was about defense. Managers were selling winners to lock in their bonuses. Banks were selling assets to lower their risk scores. Taxpayers were selling losers to harvest tax deductions. The entire pressure of December was selling pressure, nothing but downward force on prices. But the moment the calendar turned to January 1st, everything changed. The game switched to offense. The tax year is over. The selling pressure vanished. Now the new allocations kick in, and what happens next will shock you. Every major fund has a target allocation for the new year. They might want to own 2% commodities or 5% gold. Right now, they own 0. So they have to go from 0 to 5%, and they have to do it fast. They usually execute these orders in the first 5 trading days of January. This creates a massive, artificial wave of buying demand that has nothing to do with news and everything to do with asset allocation. It's a wall of money that hits the market like a tsunami. This year, the tsunami is bigger than it's ever been. Why? Because in 2025, bonds collapsed and stocks were volatile. Silver was the only thing that actually worked. So the model portfolios, the computer programs that tell bankers what to buy, are screaming one word: silver. They're mandated to buy. They have no choice. And they're about to try and squeeze their elephant-sized orders through the mouse hole of the silver futures market. Let's put an actual number on this. The global pension and endowment market manages roughly $50 trillion. Historically, they ignored commodities completely. But with inflation sticking above 5%, they're panicking. They're moving money out of the traditional 60-40 stock and bond split and into alternatives. If the global pension system decides to move just 0.1% of their assets into silver, that's $50 billion. $50 billion of new buying pressure entering the market at once. Now look at the size of the silver market. The entire annual mine production of the planet is about 800 million ounces. At $71 per ounce, that's worth roughly $56 billion total. Do you see the math problem here? The pension funds want to buy almost the entire annual supply of the planet in the first week of January. It doesn't fit. You cannot buy $50 billion of silver at $71 an ounce. There isn't enough physical metal available. So what happens when unstoppable buying force meets immovable supply constraint? The price has to act as the rationing mechanism. The price has to rise until that $50 billion buys a smaller amount of metal. If silver goes to $140, that $50 billion only buys half the annual supply. If silver goes to $280, it buys a quarter. The price has to rise to accommodate the capital. This isn't speculation or theory. This is fluid dynamics. When you pour a gallon of water into a shot glass, It overflows. Tonight, the water starts pouring and the glass is tiny. The first sign of this wave will happen tonight. Thursday, 6 March p.m., New York time. The Globe X electronic markets open. This is where the algorithms trade while the floor traders are sleeping. Usually holiday sessions are quiet and uneventful. But tonight is different because the Asian arbitrage window is still open. Remember, while New York was closed for the holiday, Shanghai was still hungry and still trading. The gap between the US price and the China price is still sitting there, waiting to be exploited. Tonight, the arbitrage bots will turn on. They'll see the gap. They'll see the cheap silver in New York. And they'll hit the buy button without hesitation. But what the banks are about to do next is even more shocking. This could create a gap up right at the open. We could see silver jump from $71.47 to $73 in the first minute of trading. If this happens, it sets the tone for everything that follows on Friday. It tells the human traders the dip is over. The buying has started. It creates a sense of urgency. Anyone who was waiting for lower prices will realize they missed the bottom. They'll panic buy. This fear of missing out will add fuel to the fire already started by the algorithms. Now let's talk about what the banks are doing, because this is where it gets interesting. Yesterday, we explained how the GSIB surcharge forced banks to sell silver to clean up their balance sheets for the year-end snapshot. They smashed the price down to $70.50. They achieved their goal. They lowered their risk score. They saved their bonuses. Mission accomplished. But now the snapshot is over. The regulators have taken their picture and left the room. The banks are free to trade again. And what do banks do when they're free to trade? They trade to make money. They know the flow is coming. They know the pension funds are buying on Friday. So do you think the banks are going to stay short? Absolutely not. They're going to front-run their own clients. JP Morgan knows that the California Teachers Pension Fund is going to buy silver tomorrow. The price has to rise until that $50 billion buys a smaller amount of metal. This aligns all the major forces in the market. The East is buying, the pension funds are buying, the banks are buying. Who's selling? Nobody. The miners are holding their supply. The dealers are out of stock. The retail investors are holding tight. This is the perfect recipe for a vertical price move. So the paper money is lining up perfectly. But what about the actual metal itself? While the markets were closed today, the physical shortage didn't take a holiday. The factories in China are still running. The mines in Mexico are still depleting their reserves. Fund is going to buy silver tomorrow. We've received reports from major online bullion dealers in the United States and Europe. They're reporting a complete blowout of inventory. Usually the week between Christmas and New Year is quiet. But this year, sales volume was up 300% compared to last year. Why the sudden surge? Because the public smells the fear. They saw the volatility. They saw the headlines about debt. They saw the crash and the recovery, and they decided to take physical possession. But here's the problem the dealers are facing. They cannot restock. The sovereign mints, the US Mint, the Royal Canadian Mint are closed for the holidays. The wholesalers are running on skeleton crews. So every ounce that was bought this week is an ounce that cannot be replaced until mid-January. The shelves are completely bare. So what did the dealers do? Did they lower the price to match the spot market drop? No, they raised the price. If you look at the premium on a Silver Eagle right now, it's approaching $20 over spot. The ask price is over $90. This is the market telling you the truth in the clearest way possible. The spot price says silver is abundant. The premium says silver is extinct. This divergence is the most reliable signal in commodities. When the paper price drops but the physical price rises, it means the paper market is broken. It means the shorts are suppressing a beach ball that's fighting to surface. And when the paper market finally breaks, it doesn't meet the physical price in the middle. It snaps up. It gaps up violently. Now let's look at the whales of the physical world, the industrial users. We talked about the January effect for pension funds, but there's also a January effect for industry. It's called procurement season. In January, companies like Samsung, Tesla, and First Solar negotiate their annual supply contracts. And this year, those negotiations are turning into absolute panic rooms. They sit down with the refiners and the miners to lock in their price and volume for the entire year. Usually this is a boring meeting. We need 10 tons. Here's the price. Done. But this year, the meeting is a panic room. The refiners are telling the industrial giants something terrifying. We don't have enough metal. The mines are depleting. The Chinese are hoarding. The recycling is failing. We can only give you 70% of what you need. Imagine you're the CEO of a solar company. You have a mandate to double production in 2026, and your supplier tells you they're cutting your silver allocation by 30%. What do? You panic. You go into the spot market and you buy everything that isn't nailed down. You pay any price. $75? Fine. $80? Fine. You just need the metal to keep the factory open. This is happening right now. While the markets are closed, procurement teams are making desperate phone calls. They're engaging in off-market transactions. They're buying silver directly from the vaults in London and Zurich. They're bypassing the COMEX entirely. This removes visible inventory from the exchange. When the COMEX opens tomorrow, the traders will look at the warehouse report and ask a simple question. Where did the silver go? It went to a solar farm in Arizona, and it's never coming back. We cannot talk about physical silver without talking about China. While New York sleeps, Shanghai eats. The price in China is still trading at a massive premium to the West. We're looking at a gap of nearly $5 per ounce. While New York was sleeping, China implemented new silver export controls today, January 1st. They're locking their doors while Wall Street is still trying to find the keys. This arbitrage is the engine of the shortage. Every day that New York trades lower than Shanghai, a fleet of airplanes takes off from JFK and Heathrow carrying silver bars to the east. This isn't conspiracy theory. It's simple math. If you can buy an iPhone for $500 in New York and sell it for $600 in Shanghai, you buy every iPhone in New York. That's exactly what's happening to silver bars. The West is being drained of its strategic reserve. We're selling our heritage for paper dollars, and China is happily taking it. They know that in 2026, the paper game ends. They want to be holding the physical chips when the music stops. And this flow of metal creates a floor under the price. The price cannot drop below the level where arbitrage becomes profitable. Right now, that floor is $71. If silver drops below $71, the Chinese buyers back up the truck. They act as the buyer of last resort. This limits the downside risk. You're investing alongside a superpower that wants to corner the market. But wait, the skeptics say. If the price is $70, the miners will just dig more. No, they won't. This is the supply cliff we discussed before. It takes 10 years to open a new mine. Even at $100 an ounce, you cannot speed up the geology. You cannot speed up the permits. You cannot speed up the construction. In fact, supply might actually drop in 2026, and the reason why is absolutely stunning. Why would supply drop when prices are soaring? Because of political risk. Look at Mexico. Look at Peru. The governments there are looking at $70 silver and getting greedy. They're talking about higher taxes. They're talking about nationalization. When governments attack miners, miners stop investing. They stop digging. They go on strike. So precisely when the world needs more silver, the political environment is ensuring we get less. This is the definition of a structural deficit. It's not fixable by price alone. It requires a decade of investment and stability. We have neither. So the industrial buyer knows that no help is coming from the mines. The retail buyer knows that no help is coming from the mints. The only place to get silver is from existing stockpiles, from the vaults. The vaults are running on fumes. So the physical market is tight. The dealers are empty. Industry is panicking. But there's a bigger storm brewing on the horizon, a storm that will make the supply shortage look like a minor inconvenience. The macro economy. Now we have to zoom out. We're going to look at the debt ceiling crisis that's scheduled to hit Washington in February. We're going to look at the bond market revolt. And we're going to explain why the Federal Reserve will be forced to print trillions of dollars in 2026 just to keep the government solvent. Silver isn't just reacting to a shortage of metal, it's reacting to a surplus of fiat currency. We're about to enter the monetary phase of the bull market, where silver stops trading like a commodity and starts trading like a currency. The physical squeeze lights the fuse. The monetary crisis is the dynamite. We're looking at the death of the dollar. We've spent time looking at the microscopic details of the silver market. We counted the ounces in the vaults. We tracked the planes flying to Shanghai. We analyzed the solar panels. But if you focus only on the metal, you miss the monster lurking behind it all. Silver does not exist in a vacuum. It exists in a world drowning in $36 trillion of United States debt. It exists in a world where the bond market is rebelling against the central banks. It exists in a world where the full faith and credit of the empire is being questioned for the first time in 80 years. Now we have to zoom out completely. We're going to look at the macro storm that's about to make landfall in the first quarter of 2026. I'm going to explain why the upcoming debt ceiling crisis in Washington is the trigger event that sends commodities into the stratosphere. We're going to analyze the bond vigilantes who are driving interest rates higher, forcing the Fed to print money just to keep the government solvent. And I'm going to show you why silver is not just an industrial metal anymore. It's a currency lifeboat. The physical squeeze lights the fuse. But the monetary collapse provides the explosion. Let's look at the debt situation. While you're celebrating the new year, the politicians in Washington are preparing for war, and what's about to happen will change everything. In February of 2026, the United States hits the debt ceiling again. We've seen this movie before. They fight, they threaten to default, they shut down the government, and then they raise the limit. But this time is different. This time, the interest on the debt has exploded. The US government is now paying over $1 trillion a year just in interest payments. That's more than the defense budget. That's more than Medicare. It's mathematically unsustainable. So when the debt ceiling fight starts next month, the market is going to panic. Credit rating agencies like Fitch and Moody's will threaten to downgrade the US credit rating again. Foreign nations will stop buying treasuries because they're scared of a technical default. This creates a crisis of confidence. When investors lose confidence in the so-called risk-free asset, US bonds, where do they go? They go to the assets that have no counterparty risk: gold and silver. During the last debt ceiling crisis, gold rallied. This time, with silver already in a shortage, the rally will be amplified beyond anything we've seen. Silver acts as a credit default swap on the US government. As the probability of government chaos rises, the price of silver rises. You're holding insurance against political incompetence, and business is absolutely booming. We need to talk about the bond market. It's the largest market in the world. It controls everything. Right now, the bond market is screaming. Yields are rising. The bond vigilantes are selling treasuries because they know inflation is not 2%. They know it's 5% or higher. Why does this matter for silver? Because higher yields break the banking system. We saw it in 2023 with Silicon Valley Bank. Banks hold bonds as collateral. When bonds crash, the banks become insolvent. If yields spike in January, we will see another banking crisis. Another regional bank will fail. Maybe a big bank will wobble. And what does the Federal Reserve do when banks fail? They pivot. They stop fighting inflation. They stop raising rates. They turn on the money printer. They create emergency liquidity facilities. They flood the system with fresh dollars to save the banks. This is the Fed put. Every time the system breaks, they print money. And every time they print money, the value of the dollar falls and the price of silver rises. We're waiting for the system to break. The bond market is doing the work for us. It's forcing the Fed into a corner where their only option is to inflate away the debt. Inflation is the fuel for the silver supercycle. While the West struggles with debt, the East is building a lifeboat. The BRICS alliance, Brazil, Russia, India, China, South Africa, and the new members, is actively moving away from the dollar. They call it de-dollarization. In 2026, we expect a major announcement regarding a BRICS trade settlement unit, a currency backed not by promises, but by hard assets: gold, oil, rare earths, and silver. China knows that to challenge the dollar, they need a currency that has intrinsic value. Paper money is a weapon used by the US. Commodity money is the shield used by the BRICS. If silver becomes a component of a global monetary reserve system, it remonetizes instantly, and what that means for the price will blow your mind. For 40 years, silver was just a commodity like copper. If it becomes money again, the valuation model changes completely. Money trades at a premium to its industrial value. Gold trades at a massive premium because it's money. Silver is currently trading at its industrial value. The monetary premium is the upside, and the BRICS nations are the ones who will apply that premium. Wall Street analysts love to talk about real interest rates. They say if interest rates are high, gold and silver should fall because they pay no yield. This is the textbook theory. But look at the reality. Interest rates are 5%. Silver is at 75. The textbook is broken. Why? Because the market knows the interest rate is fake. The real rate is interest minus actual inflation. If the bank pays you 5%, but the cost of living goes up 10%, your real rate is negative 5%. You're losing purchasing power by holding cash. Smart money knows this. They know the CPI numbers are cooked. They know that true inflation is double digits, so gold and silver are rising with interest rates. This is a historic anomaly. It usually only happens during a currency collapse. When the market stops believing the central bank, the rules of economics invert. We're living in that inversion right now. Finally, let's look at the second wave of inflation. The Fed claimed victory. They said inflation was coming down. But look at the inputs. Oil is rising. Shipping costs are rising. Labor costs are rising. Insurance costs are skyrocketing. Inflation is sticky. In the 1970s, inflation came in three waves. The first wave hit. The Fed raised rates. Inflation fell. Everyone celebrated. Then the second wave hit. It was bigger. Then the third wave hit. It was the biggest. We just finished wave one. Wave two is building. When the inflation numbers start creeping back up in 2026, the market will realize the Fed is powerless. They cannot raise rates anymore because it would bankrupt the US government, so they have to let inflation run hot. Financial repression. In a world of structural persistent inflation, you need assets that cannot be debased. Silver is the ultimate inflation hedge because it's also an industrial necessity. It protects you from the printing press, and it benefits from economic growth. It's the only asset that wins on both sides of the coin. So the macro storm is gathering, the debt is unpayable, the bonds are crashing, inflation is returning, and the physical silver market is empty. What happens when you throw a match into a room filled with dynamite? You get an explosion. But analysis is useless without execution. The analysis stops here, the execution begins now. We have reached the final chapter of this New Year's investigation. We've dissected the $50 billion wall of capital that's about to hit the market. We've exposed the physical dealer blackout and the industrial panic. We've analyzed the macro superstorm of debt and war. Now the analysis stops and the execution begins. Tonight, the electronic markets will open. Tomorrow morning, the opening bell of 2026 will ring. You have the information. You know the why. Now you need the how, and this is where it gets real. I'm going to give you the execution strategy for the first week of January. I'm going to map out the specific price targets we need to hit to confirm the supercycle. I'm going to teach you the ratio exit so you know when to walk away with your fortune. And I'm going to leave you with the final verdict on the year ahead. The year of potential is over. The year of realization is here. Let's look at the chart one last time before the candles start moving. We're sitting at $71.47. We're resting on a massive support level. So what are the targets for the first week of January? Target 1, $75. This is the previous high. This is the breakout point. If the pension funds enter aggressively on Friday, we should clear $75 within the first 48 hours of trading. If we break $75 on high volume, it confirms that the correction is over. The green light turns on. Target 2, $83. This is the wick high from the Monday squeeze. Technically, price loves to revisit the scene of the crime. The market wants to test that level again to see if the sellers are still there. I believe we will challenge $83 before the end of January. If we clear 83, we're in blue sky. Target 3, triple digits. This is the quarterly target. If the shortages are as real as the premiums suggest, and if the bond market volatility continues, there is no structural resistance between 83s and $100. It's a vacuum. The price could move from 80 to 100 faster than it moved from 20 to 30. So do not be surprised if we see a parabolic move in Q1. Be prepared for it. Do not sell into the first spike. Now I need to have a serious conversation with you. Buying is easy, selling is hard. Most investors ride a bull market all the way up and then ride it all the way down. They fall in love with the asset. They become cultists. You're not a cultist. You're an investor. The goal is to increase your purchasing power. So when do you sell? You do not sell for dollars. Dollars are the problem. You sell for gold or land or income-producing assets. We use the gold to silver ratio as our GPS. Right now, the ratio is roughly 60 to 1. This is still cheap. Historically, in a bull market, the ratio compresses. When the ratio hits 40 to 1, you pay attention. The easy money has been made. When the ratio hits 30 to 1, you start to scale out. You trade 20% of your silver for gold. You're trading the high-risk asset for the no-risk asset. You're locking in the win. When the ratio hits 15 to 1, you exit completely. You swap all your silver for gold. Or you buy a farm, or you buy an apartment building. You move from speculation to generational wealth preservation. If you follow this plan, you don't care about the dollar price. You don't care if silver is $500 or $5,000. You only care about its value relative to other real assets. Write this ratio down. Tape it to your computer. 15 to 1. That is the finish line, and you need to remember it when the mania hits. We are about to enter a mania. A mania is different from a bull market. In a bull market, people are optimistic. In a mania, people are irrational. You're going to see your friends and family, the ones who laughed at you, suddenly asking how to buy silver. You're going to see YouTube channels that talk about gaming or makeup suddenly talking about precious metals. This is the shoeshine boy indicator. When this happens, you will feel like a genius. Your ego will inflate. You will think you can do no wrong. That is the moment of maximum danger. That's when you'll be tempted to use leverage, to borrow money against your house to buy more. Do not do it. When the mania hits, your job is to be the adult in the room. Keep your head. Stick to the plan. Do not get greedy at the top. You bought at the bottom. You have already won. Your job now is just to land the plane safely. Also, prepare for the volatility. In a mania, silver can drop 20% in a day and still be in an uptrend. If you're leveraged, you die. If you're physical, you just blink. Stay unleveraged. Stay physical. Stay sane. So here's your checklist for the market open tomorrow. 1. Watch the Globex open tonight. Does it gap up? If yes, the demand is immediate. If it gaps down, it's a final trap. 2. Watch the volume on Friday morning. We want to see high volume. We want to see the pension funds stepping in. If the price rises on low volume, be suspicious. If the price rises on massive volume, it's the real deal. 3. Watch the dealers. Do the sold out signs disappear or do they stay up? If dealers are still sold out next week, the squeeze is going vertical. 4. Watch the media. Are they ignoring it? Good. We're early. Are they screaming about it? Be careful. We're getting popular. So here's the verdict. 2025 was the warm-up. 2026 is the main event. We have the perfect storm. Industrial scarcity, monetary collapse, geopolitical conflict, institutional FOMO. There is no force on earth strong enough to stop this trend. The banks tried, they failed. The governments tried, they failed. Now the market takes over. You have done the work. You have prepared. Now all you have to do is watch. This is the year you've been waiting for. This is the year silver reclaims its throne. The electronic markets open in hours. The pension funds execute on Friday. The physical shortage is real. The monetary collapse is accelerating. The price targets are clear. The exit strategy is mapped. The vaults are empty. The dealers are sold out. The industrial buyers are panicking. The banks are flipping long. The East is draining the West. The debt ceiling crisis is coming. The bond market is breaking. The Fed will print. The dollar will fall. Silver will rise. The countdown is over. The storm is here. Keep stacking.